In this series of videos, we're going to talk about inventory, and I thought, what better way to start talking about inventory than to get a decent definition of inventory? So it's good to understand it. I Googled for a definition, and this was sort of the best one I found, and it's on Investopedia, and it says, definition of inventory: the raw materials, work in process goods, and completely finished goods that are considered to be the portion of a business assets that are ready or will be ready for sale. Basically, when I think about inventory, especially when I think about it in the framework of an introduction to financial accounting, what I'm thinking about is any assets I own that I own for the express purpose of selling. So if you think about a retailer, it's the stuff they keep in stock, the stuff that's sitting on the shelf. So if I think about Walmart of the world, it's all the stuff that's sitting on the shelf waiting for the customer to buy. And that's how I like to think of inventory, at least in this context. If you're doing managerial accounting, you'll worry about raw materials and work in process. We're going to think about it from the Walmart model. They buy a good, it's already ready to sell, and then they turn around and sell it. So they buy it at one price, they turn around and sell it at a higher price, and where Walmart makes money is that point in the middle, right? They're buying at one price, they're selling for a higher price, and they make profits in the middle. So, in fact, why don't we look at how Walmart might account for the most basic of transactions? So, let's say we're Walmart and we buy a pair of socks. And certainly, if we buy a pair of socks at one price, we're going to sell them at a higher price. So, for the purpose of my example, let's say Walmart buys their socks for $2 and sells them for $5. So, we're Walmart, we buy our socks for $2. It's January the 1st. And we go, all right, we bought socks, but of course we don't call them socks. We call them inventory. And I'll just put it's socks in brackets. And in fact, Walmart would be much more specific than that. They wouldn't just say socks. They would say it's white Hanes tube socks, which is what I wear, or maybe some other brand or pair. So anyway, they buy these white tube socks for $2, and let's assume they bought from their supplier for cash. In all likelihood, Walmart would actually buy on account and have a payable, but they would never buy one pair of socks at a time anyway. This is just to illustrate an example. So now it's January 2nd, and Walmart wants to sell their socks, or they do sell their socks. No, they want to sell them right away. They do sell their socks on January 2nd. So we said if they buy them for $2, they're probably charging $5, $6, $7. Let's assume though it's $5. So they get cash of $5 from their customer, and that's how Walmart earns money. This is a revenue to them, and Walmart's revenue is called sales revenue, and any retailer's revenue is going to be called sales revenue. So they earn sales revenue of $5. Now that's good, and that's all well and good, except for we haven't tracked something very important. When any retail company makes a sale to its customer, not only do they have to record the fact that yes, cash came into the till, we sold something to our customer, we've got sales revenue happening here, we've also got to record the fact that our customer walks out of the store with a bag full of our stuff. In this case, our customer walks out of the store with some of our socks. So I have to record the fact that I have less socks. I've got to credit my socks inventory to say, yeah, when that sale happened, my sock inventory went down by $2. Now, this is going to give rise to a new expense, and it's an expense we haven't talked about yet, and that expense is called cost of goods sold. And so when Walmart sells its pair of socks, it has a cost of goods sold of $2. So the journal entry, again, whenever we're selling inventory, is always going to be debit cash or accounts receivable, credit sales revenue, debit cost of goods sold, and credit the inventory that we sold. And you can see, looking at the revenues and expenses on this transaction, our sales revenue is the only revenue in here, our cost of goods sold is the only expense. You can see, taking revenues minus expenses, we made $3 on the deal, and our accounting system caught it. So this was a very simple example, and now I want to illustrate with another very simple example that this can get harder. And so I'm going to start a new example here. Again, if you didn't understand, you can pause and rewind and kind of go over that again. But we're going to go through a more complex example here just to get a feel for the complexities of inventory. So let me get a new page. Go Plumb to the new page. There we are. And let's go. So let's use the same socks situation. Walmart buys socks. It's January the 1st, and they debit their inventory socks for and they buy them for $2. They're still planning to sell them for $5, and so they credit cash $2. Beautiful. Now let's say the socks don't sell, and on January 2nd Walmart buys another pair of socks. Now again, a ridiculous example, Walmart would buy hundreds and hundreds and hundreds of pairs of socks at a time, but in this example they're buying them one pair at a time, one day at a time. So they go to buy the socks, and Hanes or Fruit of the Loom says, you know what, Walmart, our cost of socks just went up. We're going to charge you $2.10. And Mr. Walmart says, well, I'm selling them for $5, $2.10, that ain't too bad. Fine, I'll buy the socks for $2.10. And we debit inventory socks for $2.10, and we pay cash. Again, Walmart probably would never pay cash, but for the purpose of our example, why not? So January 3rd rolls around, and the 2 pairs of socks still haven't sold, and Walmart decides, I want to buy a 3rd pair of socks. And so they call their supplier, and the supplier says, you know what? The cost today, $2.50. Walmart says, I don't like it, but okay. Again, a silly example because Walmart has very strong negotiators. They likely wouldn't take such a cost increase lightly, but they do it in this example. So they buy the socks for $2.50. I know that might not look like a 5, but it is. Credit cash, $2.50. So now Walmart has these 3 pairs of socks sitting on the shelf. The customer comes in and they buy a pair of socks. Okay, so scrolling down, we know how to sell socks. Debit cash, credit sales, debit COGS, credit inventory. So let's do that. The customer comes in on January 4th and they buy a pair of socks. So we're Walmart and we say, yay, we got cash, $5. And of course that's sales revenue to us of $5. Now we've also got to say some socks left with our customer. So I'm going to credit inventory for, well, we'll talk about that in a second, and debit cost of goods sold, which I'll here henceforth abbreviate as COGS, C-O-G-S. So now the question, and this is really the $1 million question of inventory, is how much should I debit my COGS and credit my inventory for? Again, I have 3 different pairs of socks, one at $2, one at $2.10, one at $2.50. How much should I charge to my cost of goods sold? That's the question, and the answer is there's a lot of correct answers here. It depends on the accounting policy of the company. So when I look at this situation, I could say, okay, well, if I was using milk, if I go to the supermarket and I buy milk, I notice that they always try to sell the oldest milk first. So somebody like me reaches around to the back and pulls out the fresh milk, but companies selling milk and groceries, they try to sell the oldest stuff first. And there's a term for that. If you're trying to sell your oldest inventory first, the terminology is FIFO. And FIFO stands for first in, first out. And if I have an inventory policy that matches that, I might want to account for my inventory using FIFO. So if I'm using FIFO, first in, FI, first in, FO, first out, if I'm using FIFO in this scenario, my oldest socks are the ones I would account for as having been sold. So if I were using FIFO, my COGS and my credit to inventory would be $2 because I would just take the oldest item, which would be January 1st. Now, the flip side of FIFO, you probably can guess, is called LIFO. If FIFO is first in, first out, LIFO stands for last in, first out. And it's the opposite. So FIFO says we sold the first one, LIFO says we sold the most recent one. So under LIFO, which we'll talk more about in a minute, we would charge our cost of goods sold $2.50. Now there's other methods available to us too. Some of you may be looking at this and saying, hey, just take an average. Very legitimate method. It's called the weighted average method, and we'll look at that one next. So if I were doing weighted average, I would look at these items and I would go, okay, 2 plus 210 plus 250, that's 660 divided by 3. My average cost in inventory is 220. I added them up. That's why my last one was 250. I wanted it to be an even number. So 220 is my weighted average. Beautiful. So far, so good. One other method exists that we're going to be concerned with, and that I would be concerned with in an intro to accounting class. And that method is called specific unit identification. And I'll just call it specific unit ID here. And specific unit says, well, which specific unit did the customer buy? The customer came in, he picked one off the shelf. Which one of these three did he or she pick? Was it the first, the second, or the third? Because that matters. And if I know if it was the second, then I'm going to charge $210. If I know it was the third, I'm going to charge $250. Whichever one it was, that's the one we sold. Now, specific unit identification is really used for companies that trade on unique products or companies that trade in big ticket items. So if I run an antique store and I have 3 antique tables, I'm not going to say, oh, let's take the average of the antique tables. No. I'm going to just take the, I'm going to say which specific antique table sold. Same thing if I own a car dealership, like a Mercedes-Benz dealership. I'm not going to say, oh, what's the average of my, Mercedes compressors that I sold this month? No. You're going to look at each Mercedes-Benz separately. You're going to charge cost of goods sold for each one based on some vehicle identification number. You're going to track each one separately. In those cases, use specific unit ID. For companies that sell socks, though, they're much more likely to use FIFO, LIFO, or weighted average. Now, here's where we get a bit of a difference. I'm a Canadian accounting instructor, and my friends in Europe and my friends overseas that are under IFRS, International Financial Reporting Standards, follow similar rules to Canadian GAAP, and those rules state that FIFO, weighted average, and specific unit identification are always okay, but LIFO is not. Now, our cousins to the south, our American cousins, LIFO is absolutely okay for you. But because of that, my focus here is supporting my own class. I'm going to hone in on FIFO and weighted average specifically in the next couple of videos and show you how to deal with them. Now, you're in luck, because if you can understand FIFO, LIFO's really easy. LIFO's just logically follows. It's if you get how to do FIFO, you'll get how to do LIFO. So I'm going to focus on FIFO and weighted average. I'm going to leave LIFO off because, again, it's not allowed under international standards. It's not allowed under Canadian rules, and that's really the focus, and that's my primary audience here. So we'll leave it there. Our next video will walk through an example of how a company might deal with FIFO method accounting record keeping.